Welcome back to the Deep Dive. We're here to cut through the clutter and get you straight to the insights you need. Today, we're tackling a really big question for anyone watching precious metals. Fresnillo. Is its crown as the world's silver king a solid competitive advantage, a real moat? Or is that premium valuation we're seeing maybe a bit of a gilded trap for investors? It's this core tension, right? Dominant company, but facing some serious political headwinds down in Mexico. So, our mission today is simple: give you a shortcut. A shortcut to being genuinely well-informed about Fresnillo, that's ticker FRES, on the London Stock Exchange. We're going to dissect a deep stock analysis, really unpack the operations, the financials, the strategy of this mining giant. Just for you, the curious learner.
Exactly. And the source material we're drawing from, just so you know, is a detailed multi-chapter report. It gives a really consistent snapshot as of July 24, 2025. So it's timely, it's in-depth, a real treasure trove of information we're going to guide you through.
Okay, let's jump right in. Chapter 1, Business Analysis. Where should we start? Maybe, how does Fresnillo actually make money? The basics.
Good starting point. So at its heart, Fresnillo's got this vertically integrated model. What that means is they do everything right, from finding the stuff in the ground exploration all the way to processing it. Full control. Now, most of their revenue, that comes from silver and gold sales, obviously. But here's a really clever bit. They also get significant income from byproducts, like zinc and lead. And that's not just, pocket change. It actively helps lower the cost of producing the silver and gold.
Okay, so those byproducts are actually a strategic cost advantage.
Precisely. It gives them a leg up, especially when commodity prices swing around, which, they always do.
Makes sense. And their position in the market, they're not small players, are they?
Oh, not at all. They are the world's largest primary silver producer, full stop. And Mexico's second biggest gold miner, their main mine, the Fresnillo mine itself. It's legendary. World's largest primary silver mine. And it's been running for almost 500 years.
5 centuries. Wow.
Yeah, incredible history. And this scale is not just impressive, it puts them in the FTSE 100 index in London. So they're a major player, a benchmark for the whole sector. Their market cap, around $10.78 billion, or about $14.6 billion US.
Okay, so giant in the field. Let's zoom out a bit then. What about the wider market they operate in, the precious metals market overall?
Well, the outlook for 2025 is actually pretty bullish. Projections are around $327 billion globally, with growth expected around 7.2% a year through 2032. What's driving that? A couple of things. One is investment demand, gold and silver, as that classic hedge against inflation, geopolitical uncertainty, the drill. But for silver, there's this other really interesting angle: rising industrial demand. Think green tech, solar panels, electric vehicles. They need silver.
Right, the green transition needs silver, so a strong demand picture. But here's the elephant in the room, maybe. All their mines are in Mexico, and the rules there have changed. A lot.
Yeah, you've hit on probably the most critical risk factor: Mexico's regulatory environment. It's not just a risk, it's an escalating one. Back in May 2023, there was this sweeping legislative overhaul. It shortened mining concessions 50 years down to 30. Big difference for long-term planning. It also changed how concessions are granted public bidding now, not just first come, first served. Plus, stricter social and environmental rules. It really changed the game.
And wasn't there also talk about banning open-pit mining? That sounds drastic.
Extremely drastic. There was a proposed constitutional reform floated in February 2024 to ban all open-pit mining. Now, consider this. Open-pit accounts for something like 60% of Mexico's total mining output. And for Fresnillo, it hits key gold mines like their big Herradura mine. The legality of the 2023 change is actually being fought out in the Mexican Supreme Court right now. So there's this huge cloud of uncertainty hanging over everything.
Okay, so massive uncertainty. Let's talk about their competitive advantage, then their moat, as Buffett would say. You mentioned low costs earlier. Is that their main defense?
It's definitely the cornerstone. Fresnillo's strategy revolves around having these large world-class mines that operate at very low costs, benefiting from huge economies of scale. Their goal is always to be in the lowest quartile, the cheapest 25% of global producers. And why does that matter? It means they can still make good money, generate cash, even when metal prices fall. Higher cost mines might be losing money, but Fresnillo can often stay profitable. That's a powerful moat.
Right, cost is king in mining. And beyond costs, what else? They have some unique assets too, right? Like land?
They do. They control about 1.6 million hectares of prospective land in Mexico. That's a massive pipeline for future discoveries, for organic growth, hard for others to match. And it's not just the land. They have a really well-regarded exploration team. These guys have a track record of finding and developing big mines. In an industry where new major finds are getting rarer, that's a huge plus.
Okay, so strong assets, great exploration team, low costs. But then we circle back to Mexico. How much does that geological and operational advantage count if the government can just change the rules? Is that moat being, I don't know, drained from the outside?
That's exactly the right question.
Yeah.
And yes, that's what seems to be happening. The regulatory overhaul in Mexico is effectively eroding that moat. You can have the best mines in the world, the lowest costs, but if the government changes the tax rules, shortens your right to mine, or even bans your mining method, well, the economics can fall apart pretty quickly. It's a stark reminder of how sovereign risk, the risk tied to a specific country's government actions, can just completely undermine a company's inherent strengths.
Really puts it in perspective. Okay, let's shift gears. Chapter 2, management evaluation. Who's running the show and how are they doing, especially with all these challenges?
Well, the leadership team has a lot of experience, deep industry knowledge, long tenure too. The CEO, Octavio Avidrez, he's been there since 2012 and actually spent his whole career inside Fresnillo, or its parent company, Peñoles. So he knows the business inside out. And look, this team has navigated plenty of crises before: commodity price crashes, supply chain chaos, inflation, COVID. They know how to operate in tough times.
That experience sounds valuable, but I remember reading about some issues too. Community relations, safety. Doesn't quite square with being named an ethical company, does it?
No, it doesn't. And that's a really significant point. There's a definite contrast there, maybe a say-do gap, as you put it.
Okay.
They have been named one of the world's most ethical companies, but at the same time, they face pretty severe criticism over community relations. The El Bajío land dispute is a major example. Accusations of violence, illegal occupation, things the CEO denies, but the accusations linger. And tragically, yes, their safety record has been impacted by contractor fatalities. So for investors focused on ESG, environmental, social, governance, these are serious red flags.
Yeah, definitely something you'd need to weigh. What about how they spend their money? Capital allocation. Are they disciplined? Reinvesting versus dividends?
They seem pretty disciplined, yeah. Their main focus is reinvesting back into the core business, finding new deposits, turning them into low-cost mines. Organic growth is the name of the game. For 2025, for instance, their planned capital spending is about $530 million, mostly keeping existing mines running and advancing projects, like going deeper at the Saucito mine to extend its life.
And shareholder returns, how do they handle that?
Primarily through dividends. Their policy is to pay out between 33% and 50% of their profit. But because their earnings are so volatile, tied to metal prices, the actual dividend payments have been really inconsistent, up and down. Interestingly, they did a one-off special dividend in 2024, about $308 million. You could read that as them being a bit cautious, maybe hesitant to pour huge sums into New Mexican projects, given the regulatory uncertainty. Holding back a bit, their recent return on invested capital, the ROIC, was just over 9%. That's a key number to watch for how effectively they're using that capital.
Okay, makes sense. Now let's get into the numbers that really drive the investment decision. Time for Chapter 3, financial analysis. Can you walk us through the key metrics as of, say, mid-2025?
Sure. So as of July 24, 2025, using the 2024 fiscal year data, share price was 1,438 pence on the London Stock Exchange. Market cap, like we said, $10.78 billion. Revenue for the trailing 12 months was $3.5 billion. But earnings per share, EPS, was only $0.19. And that leads to a trailing PE ratio, price to earnings, of 103.7.
Whoa, over 100. That seems incredibly high for a mining company.
It is exceptionally high, especially for a cyclical business like mining. It tells you the market is pricing in a massive recovery in earnings, a huge amount of optimism. Contrast that with the forward PE, based on analysts' expectations for future earnings, that's much lower, down at 18.55. So Wall Street clearly thinks things are going to get much better. Dividend yield was 1.68%.
Okay, so a huge valuation disconnect between past performance and future hopes. What about the balance sheet? Is it strong enough to handle potential bumps?
Oh yeah, the balance sheet is rock solid. That's one of their biggest strengths. The debt-to-equity ratio is super low, just 0.20, very little debt.
Yeah.
And their current ratio is 6.63. That's exceptionally high. It means they have loads of liquid assets to cover short-term obligations. It's genuinely a fortress balance sheet. Gives them massive flexibility. But you have to balance that strength against the inconsistency on the income statement. Revenue growth has been volatile, averaging about 6% over 5 years. and earnings, even more volatile. EPS actually declined on average over the last 5 years, about negative 9.8% per year, with huge swings, directly tied to commodity prices and also Mexican tax changes.
Fortress balance sheet, volatile earnings, quite the mix. So how do you even try to put a fair value on this? You mentioned a DCF model earlier.
Right, a discounted cash flow model. It's a standard way to estimate intrinsic value. You project out future free cash flows the company might generate, and then you discount those back to today's value using a rate that reflects the risk involved. Based on the educational model used in the source report, the estimated intrinsic value range for Fresnillo came out between 1,050 pence and 2,050 pence per share.
1,050 to 1,250 pence. And what was the key driver behind that specific range?
The biggest single factor influencing that valuation is the discount rate used, the WACC, or weighted average cost of capital. It was calculated at a very high 15.58%. Why so high? Directly because of that sovereign risk premium attached to operating entirely in Mexico right now. That risk inflates the required rate of return. And it really raises a crucial question for you, the listener. How much faith can you put in future cash flow forecasts when the entire operating environment could be upended by political decisions? It makes forecasting inherently tricky.
Absolutely, a very high discount rate reflecting very high risk. Okay, let's move into the second part. How does the market feel about Fresnillo? Let's look at Chapter 4, Market Sentiment. What are the analysts saying?
Well, the general consensus among Wall Street analysts is pretty cautious, mostly hold or neutral ratings. What's really striking, though, is the huge spread in their price targets for the next 12 months. The low end is down at 917 pence. The high end is way up at 1,850 pence. The median, or midpoint target, is 11,146 pence. Now compare that to the current share price of 1,438 pence. The median target is suggesting it's overvalued by more than 20%.
So analysts are skeptical overall, despite that wide range. What about other market signals, like short interest, people betting against the stock?
Yeah, there's definitely some significant short interest. Over 1 million shares are shorted, and the days to cover ratio is high, almost 52 days. That means, based on average trading volume, it would take nearly 52 days for all the short sellers to buy back their shares. It suggests a pretty committed group of bears who think the price is going down.
Okay, so bears are present. But what about the technical picture? Moving averages, trend lines?
Well, that's where it gets interesting, because the technicals look strong. The stock price is trading quite comfortably above its 50-day moving average, about 9% above it, around 316 pence. That signals a healthy short-term uptrend, and the longer-term picture, even stronger. It's way above its 200-day moving average, more than 60% above that level, which sits down between 900 and 1,000 pence roughly. That indicates powerful upward momentum over the past year.
Huh. So we have analysts saying hold may be overvalued, bears actively shorting it, but the price chart itself is showing strong bullish momentum. How do you reconcile that? What does it mean for an investor trying to decide?
It's a classic conflict, isn't it? Strong technicals versus stretched fundamentals and skeptical analysts. It basically suggests that momentum traders, people following the trend, are currently driving the price higher. But the value investors, the fundamental analysts, are looking at the valuation, looking at the risks, and saying, hang on a minute. So your investment decision really hinges on which force you think will win out. Will the strong trend continue to push the price up, ignoring the valuation concerns? Or is a correction back towards that fundamental value that the analysts are pointing to more likely? It's a tug of war.
A real tug of war. Okay, next chapter. Chapter 5. Ownership structure. This is quite unusual for Fresnillo, isn't it? Who actually owns the company?
Yeah, it's very concentrated. The vast majority, 75%, is owned by its parent company, Industrias Peñoles, which is also a major Mexican mining group. This makes Fresnillo technically a controlled company. Only about 25% of the shares are actually freely traded on the public market. That's the public free float.
And what does that mean practically for someone buying or selling the shares, that small free float?
It can mean increased volatility. Because there are fewer shares readily available for trading, even moderately sized buy or sell orders can sometimes move the price quite a bit, more than you'd see in a company with a much larger free float. So while having Peñoles as a stable majority owner provides some backing, that limited float is definitely something you need to be aware of as an investor. It can affect liquidity and potentially amplify price swings.
Got it. More potential for swings. Now let's circle back to risk explicitly. Chapter 6. Risk assessment. We've hit the big one already, but let's recap the major threats.
Right, doing a quick SWOT analysis. Strengths, weaknesses, opportunities, threats. The T section really hammers home what we discussed. Threat number 1, underlined, bolded, Mexican political and regulatory risk. That includes potential tax hikes, tougher environmental rules, the ongoing concession uncertainties, and that huge threat of an open-pit mining ban. Beyond that, you've still got the standard industry risks. Commodity price swings are always a factor, and cost inflation, labor, energy supplies remains a persistent challenge.
And what about broader factors like inflation? Is that good or bad for Fresnillo?
It's kind of a double-edged sword. On the one hand, inflation often drives investors towards gold and silver as safe havens, which boost Fresnillo's revenues. Good news there. But on the other hand, inflation also drives up their costs. Wages, fuel, equipment, everything gets more expensive. So as an investor, you're essentially betting that the revenue boost from higher metal prices will be bigger than the hit from rising operating costs. It's a delicate balance.
Makes sense. And any specific geopolitical things to watch, like, say, U.S. trade policy towards Mexico?
Well, direct U.S. tariffs on Mexican gold or silver seem unlikely. But broader trade friction, that could have ripple effects. More tension could increase that safe haven demand for metals, which ups Fresnillo. But there's another angle. This trend of nearshoring companies moving manufacturing to Mexico to avoid tariffs elsewhere or shorten supply chains, that could actually increase competition within Mexico for things like skilled labor, power, water, potentially driving up mining costs for Fresnillo. So it's complex.
Okay, complex indeed. Let's try to tie this all together then. Chapter 7. Conclusion. What's the final synthesis? Silver King or Gilded Trap?
Well, after digging through everything, Fresnillo presents a really complex picture. You've got these incredibly powerful assets, world-class operations facing both significant opportunities and some really profound risks. It's definitely not a simple yes or no.
So let's summarize the bull case first. Why might someone invest? The Silver King argument.
Okay, the bull case rests on a few key pillars. One, it's a premier global producer with low-cost, long-life mines. Two, it's the world's biggest silver miner, giving you huge exposure to silver's potential from both investment demand and that green tech industrial demand. Three, it has that fortress balance sheet, very little debt, lots of flexibility. Four, it has a proven exploration team and a massive land package for future growth. So if you're fundamentally bullish on gold and silver prices long-term, Fresnillo offers a potentially very leveraged way to play that.
Okay, strong assets, silver exposure, solid finances. Now, the bear case, the Gilded Trap argument. What are the main worries?
The bear case really boils down to two big things we've discussed. First, valuation. That trailing PE over 100 just looks stretched. It seems disconnected from historical earnings and demands near-perfect execution and continued high metal prices. Very little margin for error. Second, and arguably more important, is that sovereign risk. Their entire asset base is in Mexico, where the regulatory environment has become demonstrably less friendly, even hostile. That proposed open-pit ban is a massive shadow hanging over them. Plus, those unresolved community relations issues add another layer of risk.
And just to reiterate the valuation bottom line from the DCF model.
Right, that educational DCF model, which tried to account for that high Mexican risk via a high discount rate, estimated the intrinsic value between 1,050 pence and 1,250 pence per share.
And the share price when this analysis was done was
1,438.0 pence. So trading at a significant premium to that estimated fundamental value range. What this suggests is the market right now seems overly optimistic. It appears to be banking heavily on high metal prices continuing indefinitely, while perhaps not fully pricing in the severity of those political and regulatory risks in Mexico. The company has real strengths, no doubt, but the current price seems to demand a lot of things go right, many of which are outside management's control.
So for you, the listener, what this deep dive really illustrates is how even a company with fantastic assets and a rock-solid balance sheet can have its value proposition dramatically altered by external forces, like sovereign risk. It's a key lesson in global investing.
Absolutely. Sometimes the biggest risks aren't operational, they're political. The ground can literally shift beneath a company's feet.
Well, we hope this deep dive into Fresnillo Plec has given you that shortcut to being well-informed and maybe shed some light on the complexities, the surprises within the mining sector. If you found this valuable, please do hit that like button and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. And remember, for just €4.99 a month, members get priority requests for deep dives on specific tickers. We're planning to cover all the S&P 500 stocks over the coming months, and members get first dibs. Want a one-off deep dive on a company you're watching? Just drop us a super thanks on the video.
And just the important reminder, this analysis was generated by an AI system. It's purely for educational purposes. It is absolutely not financial advice. Please always do your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions.
Absolutely. And as always, keep digging for those insights. We'll be right here to help you unpack them next time.